welcome to episode 29 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event driven activity over the past week. My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
What we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as our merger arbitrage tool, check out insidearbitrage.com.
On today's podcast, we'll discuss a potential large acquisition of Norfolk Southern by Union Pacific, a potential bidding war for DallasNews, the spinoff of Beyond's blockchain assets, stock buybacks at Bank of America and Southwest Airlines, insider purchases at a Solana treasury company, as well as a food products company, a new CFO appointment at a beaten-down cancer biotech company, and a whole lot more.
So let's get started with potential deals. One of the biggest potential deal rumors last week was that of the railroad Norfolk Southern being acquired by its larger rival Union Pacific. And this just isn't a rumor because Union Pacific actually confirmed that it is in advanced merger discussions with Norfolk Southern.
If a deal were to happen, and depending on the premium paid, it could rank among the top 10 largest acquisitions over the last 10 years. Norfolk Southern has an enterprise value of $80 billion compared to Union Pacific's $134 billion enterprise value.
Imagine that this could be a combined railroad with $250 billion of enterprise value. Norfolk Southern's roots are mostly concentrated in the eastern part of the United States, while Union Pacific covers the West and the Midwest. So both companies have some level of overlap in Illinois and Missouri.
Exactly. So this merger will create a coast-to-coast network, which could actually benefit customers but could hurt competitors that don't have a vast integrated network.
Yeah, the last big railroad acquisition was that of Kansas City Southern by Canadian Pacific. I don't know if you remember this, but this deal was subject to a bidding war between Canadian National and Canadian Pacific, with Canadian Pacific eventually emerging as a winner and finally inking a deal in September 2021.
While that deal officially closed in just 90 days, the U.S. Surface Transportation Board, which oversees the freight rail industry, provided its final approval more than 15 months later in March 2023. Kansas City stock was placed in a voting trust until this approval was received.
Yeah, we were discussing last week how 4 large acquisitions, including that of US Steel, Juniper Networks, Ansys, and Hess, were all allowed to close recently, and that a deal like Norfolk Southern and Union Pacific would not even have been contemplated under the old regulatory regime.
But don't antitrust regulators have a role to play in protecting consumers from monopolies or price collusion?
Yes, absolutely, they do. But just like with everything else, sometimes regulators can step outside their bounds and not make rational decisions, right? So they might go overboard, if you will.
Yeah, speaking of irrationality, I'm curious if there was much of a benefit to consumers for blocking the Spirit Airlines and Frontier deal and having the company go bankrupt while allowing Alaska Airlines to acquire Hawaiian Airlines.
Yeah, I know this is anecdotal data, but I was recently looking for tickets to the island of Oahu in Hawaii. And not only were the ticket prices higher than I remember them from prior years, could just be inflation and maybe high oil prices, but you can also see how closely Alaska prices track United's prices. So yes, regulators have an important role to play in protecting consumers, as long as it is not taken to its irrational extreme.
Getting back to the railroad merger, CSX, which operates a nearly 20,000-mile rail network east of the Mississippi River and parts of Canada, indicated that it was open to an acquisition in light of this mega merger between Norfolk Southern and Union Pacific.
Yeah, it's possible that they don't have any option but to merge in order to compete with this behemoth that will be created if Norfolk Southern and Union Pacific are allowed to merge. It is also worth mentioning that Norfolk Southern was a railroad that came under a lot of scrutiny after a train carrying hazardous chemicals derailed in Ohio and led to a fire that burned for days and caused evacuations.
Norfolk Southern eventually settled in a $600 million class action lawsuit with residents, and there was a separate $310 million settlement with the EPA.
Yeah, it's also worth mentioning that in light of the recent events related to executives of astronomer at a Coldplay concert, that Norfolk Southern faced a similar scandal last year, and the company terminated the employment of both its CEO and chief legal officer due to a relationship between them.
Speaking of potential deals, it is worth mentioning that Goldman Sachs CEO David Solomon held takeover talks with Northern Trust earlier this year. We had earlier mentioned that Northern Trust was in play, with the Wall Street Journal reporting that the Bank of New York Mellon had approached Northern Trust, but Northern Trust indicated that it was committed to staying independent.
Switching gears to current deals and a potential bidding war, Dallas News announced that it received an unsolicited, non-binding proposal from MNG Enterprises, an affiliate of Alden Global Capital, to acquire the company for $16.50 per share in cash.
2 weeks ago, Dallas News agreed to be taken private by the magazine and newspaper giant Hearst in a roughly $75 million deal for $14 per share, so it's not that big to begin with. Hearst is still surviving in a shrinking industry and owns newspapers like the Houston Chronicle and the San Francisco Chronicle, as well as magazines like Cosmopolitan, Esquire, and Good Housekeeping.
Yeah, as I was looking at Hearst, I realized that they do a whole lot more than having a dying business in newspapers and magazines. They also own 35 television stations and stakes in cable networks like Lifetime and ESPN. Thankfully, they also expanded the business and own software and business services businesses like Fitch and the Motor Trend Group. Moreover, they also have an agreement with OpenAI. So if you think about all these LLMs that need a lot of data to train their models on, a company like Hertz might have a lot of data from their old newspaper articles as well as their magazine articles.
M&G, which is coming in with the $16.50 per share bid, is a Colorado-based newspaper publisher with publications such as the Denver Post, the Mercury News, and the Boston Herald. M&G had offered to acquire Gannett, trading under GCI, the publisher of USA Today, in 2019, but failed to enter an agreement.
With Dallas News currently trading at just $14.69, the deal has a negative spread of about 5%, indicating that the market believes that the company might accept this higher offer from M&G or negotiate a better deal with Hearst, but that the probability of this outcome is low. If Hearst comes out with a higher offer, or the Dallas News decides that the M&G deal is a superior offer, we could very easily see the stock jump up to that $16.50 level within the next few weeks.
But it's worth repeating that this deal is very much a microcap tiny deal, and daily trading volumes will be very low, so the potential to actually get into this deal and into the possible bidding war, might be difficult. To wrap up our M&A section, we briefly wanted to mention that Concentra is back with another acquisition. This time, they are going to acquire ITOs for $236 million. The deal does follow a very similar structure to the previous deals that we've discussed with Concentra, with a CVR added for any additional cash left from the sales of any assets owned by ITOs.
To wrap up this section, we also wanted to mention that Paramount and Skydance finally received their FCC approval, and the deal is now expected to close by August 7th.
Continuing on to the spin-off section of this podcast, in late 2023, we used to see insider purchases at the online retailer then known as Overstock by director Marcus Lemonis. The purchases stood out for multiple reasons. Firstly, after the homeware retail chain Bed Bath & Beyond went bankrupt in 2023, Overstock was the company to buy the business's intellectual property assets for about $21.5 million and eventually ended up rebranding to Beyond, selling products under the Bed Bath & Beyond brand.
Overstock has a fascinating history even prior to the acquisition of the Bed Bath & Beyond brand, filled with controversies including lawsuits related to naked short selling, family drama between the company's former CEO and his father, and the creation of fake websites that led to penalties being imposed by Google and limiting traffic to the online retailer.
Which, as you can imagine, limited traffic due to Google imposing a penalty on you would very much hurt a retail business. So investors were not happy, the company was not happy, but to be fair, they got themselves in the situation to begin with.
Indeed.
I think the tip of the iceberg was when Overstock's CEO resigned, claiming that he had entanglements with the deep state, after he revealed that he had been romantically involved with a Russian operative jailed for failing to register as a foreign agent. And mind you, all of this information wasn't part of some expose or another by a short seller. The former CEO revealed it all of his own free will as part of his decision to resign. But the connection between the two events as to why that impacted his business itself remains unclear to this day.
I had completely forgotten about all that drama. I do remember him getting very mad at short sellers a very long time ago. You have to remember that coming out of that 2000 dot-com bear market, people thought Overstock actually had some chance of, benefiting from the kind of gains Amazon was seeing. But it was a lot of mismanagement and, that brand went nowhere. Moving back to the present, soon after Overstock rebranded to Beyond, the director we used to see purchase shares frequently, Marcus Lemonis, became chairman of the company. I believe he's now also the CEO of the business. Marcus Lemonis has an equally fascinating background. He serves as the CEO and chairman of RV retailer Camping World, but was also a star of the 8th-season CNBC reality show The Profit, a show about saving small businesses.
Fascinating company from start to finish, but it doesn't end there. In addition to operating in the online retail space, Overstock owns a blockchain asset portfolio called Medici Ventures. Medici Ventures owns or invests in numerous crypto-related companies in addition to holding blockchain assets itself. Earlier this week, Marcus Lemonis sent a letter to the board of T0 asking the company to take action to create shareholder value by either listing itself on the NYSE via a SPAC or an IPO.
Considering the sudden popularity of SPACs once again, maybe they might be able to pull it off this time. Founded within Overstock in 2014, T0 is a blockchain-powered trading platform for securities such as equities and bonds, as well as, more recently, crypto tokens related to the company's intellectual property. This is fascinating.
And it only continues. Following Marcus Lemonis's letter, the investment management firm Shea Capital sent a letter to Beyond's board, so they're going directly to him, encouraging the monetization of other assets within the Medici Ventures portfolio, including GrainChain, which is a blockchain transaction platform for the agriculture industry.
It feels like so many layers on top of each other, and it's entirely unclear what the value of any of this is. Shea Capital supported the T0 IPO and also asked that Beyond's ownership in GrainChain be put into a special SPV or a special purpose vehicle. Shea Capital wanted Beyond to issue shares of this SPV as a dividend to all Beyond shareholders and to also list the SPV on the NYSE as a tracker stock, taking something out of John Malone's playbook here.
That's exactly what I was reminded of, because there's another tracker stock about to be created if the Shea Capital management plan goes to plan. Shea Capital also wanted to distribute a CVR to all Beyond shareholders tied to the monetization of the Medici Ventures portfolio, excluding T0 and GrainChain, which could also be traded on the NYSE as well via tracking stock. Now, Beyond has dropped slightly since the start of this week, reflecting the market skepticism that all of these changes will happen, but it is still up nearly 40% from where it was at the start of this month, indicating that there is potential for a spinoff to create some value in some way, shape, or form.
However, much like deals in the works, there is no guarantee of a spinoff or an IPO of T0 until the companies officially make an announcement. You know how this is going to work out. We find the whole situation so amusing, and just watch as this thing goes up 400% as it gets caught in a meme stock mania or all this bubble that we're seeing right now with crypto assets or with SPACs.
Highly likely that's going to happen either way. But moving on into the buyback world, so something a little bit more grounded aside from blockchain, This week was truly the week of buybacks. We saw multiple fascinating and massive buybacks from a wide range of companies. And we'll briefly cover a few in this section. We've actually seen a continuation of the trend that we've been seeing over the last few weeks, where many of the major banks have been announcing massive buybacks. We just saw Bank of America announce a whopping $40 billion buyback this week, representing approximately 11% of their market cap at announcement.
This new share repurchase program will replace the current program of $25 billion, under which approximately $9.1 billion still remains.
Bank of America does follow through on their buyback program to a certain extent. They've reduced shares outstanding by about 12% over the last 4 years, and the company also bumped up their quarterly dividend by 8% to 28 cents per share, representing a yield of 2.31%.
So along similar lines, we also saw the asset management giant Charles Schwab announce a $20 billion buyback, also representing about 11% of its market cap at announcement.
Charles Schwab's stock has surged recently, hitting an all-time high of over $97 per share, following impressive Q2 2025 results reported last week. Charles Schwab reported 25% revenue growth for the quarter, and net new assets came in at $80.3 billion, up 31% year over year.
I guess this rising stock market has been a boon for everyone from Charles Schwab to Robin Hood. Switching gears to another buyback announcement, Southwest Airlines announced a $2 billion buyback, representing about 9% of its market cap at announcement. Unlike the previous two companies, though, Southwest did not report stellar financial results, and the stock is down about 10% in the last week after the company missed Q2 2025 earnings estimates on both the top and bottom lines.
The future doesn't look all that bright either. The company revised full-year EBIT guidance to a range between $600 million to $800 million, down from the previously estimated $1.7 billion. The timing of this buyback is interesting, especially considering that Southwest still has a considerable chunk of debt on the balance sheet. Nevertheless, the endless C-suite transitions we saw at the start of this year and last might make a turnaround possible down the line.
Yeah, it looks like all the changes that Elliott management wanted at the company haven't quite yielded results just yet. I know that Southwest Airlines now shows up on Expedia when you're looking for trips, and they started charging for bags, which used to fly for free in Southwest. So let's see if all this financial engineering, the C-suite transitions, and all the changes will down the road make a difference in Southwest Airlines. We could spend the rest of this podcast talking about buybacks, but in the interest of time, we'll quickly name a few other buybacks we found interesting. The healthcare services company Tenet Healthcare announced a $1.5 billion buyback, representing 10% of its market cap at announcement. Tenet has been repurchasing shares quite aggressively, with shares outstanding having decreased by 16% over the last 3 years.
It's also worth mentioning that we saw a few buybacks at companies that we've discussed on this podcast before. Churchill Downs, the home of the Kentucky Derby, and the owner of numerous casinos and racing tracks, announced a $500 million 6% buyback, which, coupled with their insider purchases, might make the company a contender for our Double Dipper screen, which tracks insiders buying stock on the open market at the same time that companies are repurchasing shares.
Yeah, that one was interesting when I saw that come across. We also saw Icon, a clinical research organization or CRO, announce a $500 million buyback. We talked about Icon and Medpace, another CRO that ran up 56% in a single day after they released strong financial results, extensively in an interview with Luis Sanchez a few weeks ago. Last but not least, United Rentals, the company that was set to acquire Herc before H&E Equipment Services swooped in to acquire the business, also announced a $500 million buyback.
$500 million seems to be the magic number for all these companies, funnily enough, especially considering we've talked about them at various capacities on this podcast before.
Yeah, what's $500 million between friends, right? Let's switch to insiders. Earlier this month, I was listening to the Absolute Return podcast by Julian Kaimochko featuring Meteora Capital's Vic Mittal and Upexi's Chief Strategy Officer Brian Rudick. Before listening to this episode, I was not aware that there were companies that are classified as Solana treasury companies.
Just like MicroStrategy decided to become a Bitcoin treasury company by not just holding Bitcoin on its balance sheet, but also raising additional cash through secondary offerings to buy even more Bitcoin, Upexi is a company that holds Solana on its balance sheet.
Solana is an open source blockchain platform that, in some sense, is a competitor of Ethereum and allows developers to create and deploy smart contracts.
Considering that Solana was launched in 2020, it is a relatively new blockchain platform.
Yeah, we don't aim to become cryptocurrency or blockchain focused podcast, but it was interesting for me to see insider transactions by both the CEO and a director, where CEO Alan Marshall purchased $800,000 worth of stock and director Lawrence Dugar purchased almost $100,000 worth of Upexi stock.
Upexi started out as a diversified brand owner that sold everything from medicinal mushrooms to pet products before pivoting to become a Solana treasury company.
The stock is down, as you would expect, 95% over the last 5 years. It looks like magic mushrooms didn't do much to help it on that front. And I don't know if they'll be able to engineer something like what MicroStrategy has pulled off, where the stock is up more than 3,300% over the last 5 years.
That's absolutely insane. MicroStrategy was definitely one of the first of its kind, which might have been the reason that the stock has performed so well. But in some sense, it's also based on the performance of Bitcoin and Solana, respectively.
Indeed. It seemed like, endless free money where there were these secondary offerings and he was buying Bitcoin. And then eventually Bitcoin went up a lot and hence the stock is appreciating with expectations of future offerings by them, switching from a company that is more in the ether to something that is grounded on Mother Earth. Simply Good Foods saw its CEO, Jeff Tanner, purchase nearly $200,000 worth of stock. What I found really interesting about this company, which owns the brands Atkins, Quest, and Owen, is that revenue and net income growth has been excellent over the last 5 years.
And they managed to do it all without too much debt on the balance sheet. The company has a market cap of over $3.3 billion, and net debt is just $150 million.
You know that I'm generally not too keen on consumer packaged goods companies and especially food product companies. That's like a big no-no for me. However, this company's strong financial performance and the Atkins brand stood out to me. At one point, more than 2 decades ago, basically a generation ago for most people listening, the Atkins diet was all the rage, with its founder, Dr. Robert Atkins, promoting a low-carb diet that advocated the consumption of meat, cheese, eggs, butter, and other high-fat and high-protein foods to achieve weight loss.
Yeah, that seems kind of counterintuitive. And I've never heard of this diet until now, but as I'm now learning, the diet lost its popularity after Richard Atkins died at the age of 72 after slipping on an icy sidewalk. After his death, his records indicated a history of heart problems, including a previous heart attack and hypertension.
So while low-carb diets and other diets like keto remain popular, Atkins faded from the consumer memory, and in this new world of weight loss drugs, they appear to be an even less relevant brand.
However, looking at Simply Good Foods' performance, they are clearly doing something right, as the stock is trading at just 17 times forward earnings.
Last week we talked about how the entertainment company Dave & Buster's got a new CEO, and sure enough, we saw the company's CEO purchase shares this week. Tarun Lal purchased about $250,000 worth of Dave & Buster's stock, and this purchase only adds to his holdings of the company, especially considering the hundreds of thousands of stock options and RSUs he's already been granted.
We tend to see insiders purchase shares shortly after they join a new company, almost as a vote of confidence in the stock in some sense, and Dave & Buster's new CEO was no exception. Another insider transaction worth mentioning is a large $2.44 million worth of a stock purchase by Elevance Health's CEO, Gail Boudreaux.
Gail was previously the CEO of the United Healthcare division of United Health Group, and she joined the health insurance company Anthem as its CEO in 2017. This is only the second time she has purchased shares of Elevance. The first was in 2020 when the company was still called Anthem.
The second time was earlier this month when she purchased shares at an average price of $287 after the stock declined nearly 45% over the last year.
Yeah, the US healthcare system remains a big mess, and most of these healthcare insurers have seen their stock drop precipitously over the last year. In addition to this Elevance purchase, we also saw the insiders of United Health purchase shares in May of this year after the stock lost more than half of its value in a matter of days.
Continuing on to the activist section of this podcast, the battle between BP and Elliott is one that we've discussed across multiple episodes for quite some time now, and it seems no closer to resolution. BP announced a new chairman this week, amidst big push from Elliott and investors alike for the oil and gas giant to focus on oil and gas production. Elliott, as is typical, was unhappy with senior leadership, and Albert Manifold was brought in as the new chairman effective October 1st.
Mr. Manifold was previously the CEO of CRH, the building materials giant, and oddly enough, he has had no senior experience in the energy sector. However, during his 11-year tenure at CRH, the Irish company's shares sold fivefold as it reshaped its portfolio.
This week, Elliott also disclosed their stake in Equinix, a global data center REIT that operates co-location data centers where companies can house their servers, networking equipment, and IT infrastructure.
Equinix's shares have fallen more than 16% this year, and the stock suffered its worst one-day drop since March 2020 last month, after an analyst day during which the company revealed that higher than expected capital expenditures were in the cards.
Elliott disclosed that it has a tiny stake, just 0.2% of Equinix, but has been building its position since the analyst day. While the exact reason for the stake and any future plans are yet to be disclosed, I'm curious to see if we'll see any further letters by Elliott outlining what their hopes are for the company down the road. And knowing Elliott's history of writing letters to BP, to Honeywell, and so on and so forth, I wouldn't be surprised if one comes through.
And it's interesting that they signal that they're going to continue building that stake. I mean, a 0.2% stake is very small for them. So we are likely to see some buying upward pressure on the company if Elliott continues. Finally, switching to C-suite transitions, it is worth mentioning that the biotech company Iovance appointed Corleen Roche as its new CFO. Iovance is a company we have covered on Inside Arbitrage multiple times in the past, especially after a noted biotech billionaire investor, Wayne Rothbaum, bought the stock.
The company has had a difficult few quarters where, despite its drug for the treatment of melanoma, a type of skin cancer, getting FDA approval, the stock dropped by more than 95% over the last 5 years.
The company has a unique approach to fighting cancer, where Iovance takes the body's naturally occurring tumor-infiltrating lymphocyte cells, cultivates them outside the body, and then re-injects them in the patient.
Given the complexity of this process and manufacturing issues, the company's revenue growth has not been as strong as expected, and it is still posting a string of losses. Over the last month, though, the stock rebounded nearly 80% from its lows, not because it became a meme stock overnight, but because its competitor, Replimune, had its skin cancer drug rejected by the FDA.
Getting back to Iovance's new CFO, Corleen Roche, a friend mentioned her strong background to me, which includes a stint as Wyatt's CFO before Pfizer acquired the company in 2009. She was later the CFO of Sandoz, Biogen, Immunome, and CG Oncology.
And that wraps up episode 29 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decision.